Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and success strategies. Hello, I'm Michael Bull. Thank you for being with us. This segment is brought to you by BOMI.org. They have the industry standard training for property management and facilities management. Check them out at BOMI.org. Well, we have another fantastic show for you today. We're going to talk about the expectations and market realities in real estate 2019. Now, this is an incredible report. It's put out annually, and it's been around for 9 years. And it's put out by Situs, the National Association of REALTORS, and Deloitte. And they get together. It's an incredible report. And today we have a special guest. We have George Ratiu. And George is Director of Quantitative and Commercial Resource with the National Association of REALTORS. And welcome, George. Thanks for being with us today.
Thank you, Michael. It's a pleasure being with you today.
Well, this is an incredible report, and I think it's a special timing to talk about the outlook, because people are concerned about the outlook, right? This cycle has been different than the cycles we've seen before. It's a little long in the tooth. The recovery's been a little bit slow compared to some of the past recoveries, and you got to kind of start out here and talk about uncharted territory. So what do you mean there? Is that related to this cycle?
Yes, it certainly is. And you make such a good point. I mean, when we look at the economy, when we look at real estate markets, it's quite evident that we are in uncharted territory. For one, we're really marching on a major milestone from an economic standpoint. So by the summer of this year, if the economic recovery continues unabated, we will have celebrated 10 years of economic expansion, which frankly would be the longest on record, at least going back to 1850, as far as we have obviously historical data on economic activity, which, as you know, economics is known as the dismal science, and economists themselves sometimes are not the happiest of a bunch. So when economists get a little bit excited, something's in the air. Conversely, you're also right. For real estate markets, this cycle has been quite different. I remember a few years ago having a conversation with someone from New York. We were talking about the markets, and he was making the point that, if these markets continue at this point, we might have the longest in history. He was doubting that. My view was, based on activity on the ground in small cap, secondary, tertiary markets, which took 3 years to enter the recovery later than the large cap markets, we had quite a bit of room still to run. So to your point, this real estate cycle is unlike previous ones. Based on the findings of our three organizations, Deloitte, Situs RERC, and the National Association of REALTORS, we expect the cycle to continue at least into 2019, which obviously it makes it puts us in a quite different environment.
So 2019, now we're in 2019 as we tape this today. We're in February. So what about 2020?
Well, I think there are a lot of questions about the viability of the economic expansion. And what I mean by that, where we are today in 2019 is really a result of unprecedented monetary policy in the wake of, obviously, the Great Recession and the financial crisis of 2008. We had the Fed, in a sense, maintain a zero lower bound in terms of its target funds rate, short-term rates, for practically 8 years. They didn't start raising interest rates until 2015, and even then in December. So a lot of money obviously has been added to the Fed's balance sheet. The idea was to stabilize the financial system, stabilize the banks, and then have the banks infuse money into the economy, obviously through lending to businesses, lending to real estate, lending to consumers. And so obviously this has worked well, which has pushed the economy to the point where it is today, at least as of 2018 latest data. The 2018 economic growth in terms of GDP was the fastest of the last decade. In addition, we had the Tax Act, of December 2017, which went into effect in 2018, reducing the corporate tax rate obviously significantly. So that simply fueled a little more of the economic activity. So for 2019, we still see that momentum carrying forward. However, it's somewhat, when you look at the history, we're talking about history, there is a cyclicality to economic activity. And generally, we tend to see roughly every 10 years an economic recession. And as the Federal Reserve has now moved to tighten its monetary policy, obviously we're going to see some tightening in credit. We've already seen interest rates move up. So the likely impact of those is to show up as slight tapering in economic activity. So for a lot of economists, we're seeing 2019 actually continued growth, but moderating. And 2020, we are, for a lot of folks in the economics field, that there's a probability of recession rising in terms of visibility.
Yeah, well, we don't like the R word. So what do you guys think about, what do you forecast for GDP moving forward into 2019? And did that adjust any in the fourth quarter where we saw a government, partial government shutdown? We saw some turmoil in the stock market.
Very good point. So in terms of our baseline scenario in the report, we're expecting GDP to be between 1.8 and 2.3% this year, which is a slight moderation from 2018. And to put that into a broader perspective, globally speaking, we're seeing moderation in economic activity. The IMF started 2018 last year on a pretty upbeat note. They actually revised their forecast upwards of economic activity from 3.7 towards 3.9. Well, the second half of the year poured a little bit of cold water on that, and their forecast, recent one, it was actually a downgrade, roughly to about 3.5%, mostly on slowdown in China, slowdown in Europe. So obviously the U.S. is part of this broader slowdown. The GDP data for the fourth quarter is coming up at the tail end of February 28th. The Bureau of Economic Analysis will release it. And the expectation is that the government shutdown will show an impact in activity, probably a lot stronger in the first quarter of 2019. But I think that last quarter of 2018 will also show a slight moderation. And as you pointed out, financial markets obviously tend to be a little bit ahead of the curve many times. And we saw quite a bit of volatility in the fourth quarter in terms of equity markets.
So at that point, you guys were working on this report. This doesn't happen overnight. You were working on it. So when the government shutdown is going on, and it continued to go on, what was it, 30-something days? Did that adjust your outlook at that time?
It did a little bit, and especially since we provide the baseline scenario, but we also have the best case scenario and a lesser case, a worst case scenario. So we're trying to capture some of that on the downside risk. Normally, the expectations are with the government shutdown, you see a temporary decline, particularly in retail sales and consumption, personal consumption expenditures. Generally, you see there's a rebound in the subsequent quarter. This one, you're right, it went longer than any prior government shutdown. So obviously, you are likely to register declining consumption. The big question, and I think that at least coming from Washington right now, the mood seems to have tempered on another government shutdown. So I think that all things being equal and without another one, we are likely to have a weak first quarter or weaker, followed by a sort of a return to trend, at least the trend of the last 9-10 years.
Yeah, well, that shutdown seemed to undermine confidence, at least in my mind, of the government and how they operate. So what do you say about interest rates moving forward? What would you guys expect in 2019 in this report?
Well, we certainly have had quite a change in the way the Fed has been moving with its forward guidance on monetary policy, right? So obviously the Fed was quite worried in this last year in 2018 about the rate of inflation, given the fact that we are at a sub 4% unemployment rate. Prices have been moving basically to, and in fact a little above, to averaged about 2.1% for the better part of 2018. And when you look at the housing component, that's been basically close to 3%. So there's a lot of upward pressure building on inflation. So the Fed, not surprisingly, moved with four interest rate hikes this past year, and the expectation until the fourth quarter on the market was we would see another possibly 3 to 4 this year. Well, we saw at the December meeting that even though the Fed hiked the rate, what it pronounced is that they were going to become a lot more patient going forward, not surprisingly in light of the financial market volatility. In addition, the Fed said it would pay a lot more attention to the data coming out and let some of the data as it unfolded and came out in 2019 guide its decision, thereby signaling to markets that there will likely be much fewer than anticipated rate hikes this year. So right now, I think the consensus is for maybe 1 to 2 rate hikes at most.
And those would be quarter point hikes, it would be your estimate?
That's been obviously the way in which the Fed has chosen to move so far. As I said, December 2015 marked the first time they started raising the short-term interest rate, and it's been in quarter point increments. And I don't see that changing in 2019.
Okay. And when you look at a cycle like this, it's been a great cycle, and real estate's really performed well. And you look at the dynamics of real estate, you look at unemployment, you look at what's the confidence level of small businesses, and there's a lot of things that kind of point to commercial real estate is maybe a safe alternative. What do you guys say about that? Are some people looking to diversify, and maybe might that help commercial real estate moving forward? That, hey, you do have sticks and bricks, you do have something there you can reach out and touch and have some income, even though, albeit it might adjust. Is that considered maybe a safe alternative?
Absolutely, and in fact, the one thing that was interesting to note. So part of the report, we look at capital markets, and we take a look at obviously the full environment of capital markets. But one of the question, and it comes from the great team at Situs RERC, they survey investors on their preferences for assets in terms of return versus risk. And as you know, traditionally, real estate tended to slot between bonds and stocks. So they provide stronger returns than bonds, or the slightly higher risk, but a little bit lower than stocks to reflect obviously the risk, in part because commercial real estate in particular has more of a hybrid bond feel, right? You get cash flow and appreciation over the long term. What we've noticed during this cycle, and the folks at Situs pointed out, and it's in the report, is investor preferences have skewed on the upward towards commercial real estate. In fact, commercial real estate has broken out of its traditional place and has risen above stocks in terms of investor preferences. So right now, investors tend to actually favor commercial real estate over stocks, over bonds, over cash in terms of returns. And that preference hit a peak in 2015, and it's been on a gentle downward slope. But in 2018, particularly the second part of the year, that preference actually spiked up. So it's obvious that the financial market volatility has continued to place commercial real estate on a pretty significant preference list for investors. And to your point, this cycle, especially what we've seen is real estate perform quite well. And as you point out, at the end of the day, there's a solid asset, something you can see, something that generates cash flow, and obviously to some extent for some folks, it provides a hedge on the downside during inflationary periods. It's also good on the upside. So I think that in fact will continue, and we've seen a lot of investors, global, domestic ones, shift a lot of their allocation policies in terms of funding towards real estate.
Well, that'd be interesting. So if we do get a recession in 2020, to see how much it really impacts commercial real estate. Well, we're going to take a short break. When we get back, I'm going to talk to George about some of the property types, some of the sectors, and what they're expecting in this report, expectations and market realities in real estate 2019, uncharted territory. So stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show.